Hello, everybody. It is Michael here from My Retirement Trading. And today we have a very special guest. We're going to talk about leveraged ETFs. But before I get into that, I must state that none of this is financial advice or a recommendation, and it is for entertainment purposes only. With that being said, let's welcome our special guest, founder and CEO of AOT Invest, John Tinsman. Welcome to the channel.
Yo, what's up, everybody? It's a pleasure to be back with you.
All right. So, this over the recent few months, I've personally got into selling options again, and I've been using some of these leveraged ETFs, and it's been an interesting ride. And recently, I seen a video that you did with Marcos Mia, and it was basically covering some of the same things, and I was really inspired by that. So I invited you on the channel to discuss that with me.
Yeah, I've been using leverage ETFs for a while myself. They're really complex vehicles. It takes a lot of understanding, and a lot of the information you really need to make decisions aren't isn't easily discernible for most investors. So just like the more knowledge you can spread on these and the ways to use them, in the safest way, I think is there's a lot of pros, which I think sometimes are bigger than what people realize, and I think there's a lot of cons which are also much bigger than people realize. So just being able to be there and talk about how I use them is, and hopefully it can benefit some people that can maybe use them in a way that's better than they are using them now. So it's great to be here and share those thoughts with
Yeah, the one that I've been using the most is a TQQQ,
you.
and it's triple leveraged on the Nasdaq, and it's been very interesting. I've been selling puts on down days on it and trying to stay away. Like, say if it's $50, I'll sell like a $45 put, trying to stay away from it, and hoping that the uh, it bounces back up in this body option back, and it seems to have been okay doing that kind of strategy, but I know that there's a lot of risk involved with that. And can you talk about some of the pros and cons of these?
Well, I guess the first question for you, before I talk about the pros and the cons, is have you ever looked at your strategy and compared it to what if I would have sold the same like delta exposure to the Nasdaq, but done three, but so basically you'd be maybe selling 3x options or whatever, but you're selling it on the TQ or not the TQQQ, but just the QQQ, and you could compare yourself, hey, if I had sold these options at the same point, so every time you go to make that TQQQ trade, like compare to what you would have sold the QQQQ for, and then see how they each turn out. Because I actually think if you already have a margin account and you're doing that, you might be better off just selling the same delta exposure to the Nasdaq in the Qs instead of the TQQQ. That's like my suspicion, just because there's really high expenses associated um, with these funds, from volatility decay to interest expenses, and you could probably, I think, if you were taking a long position, you might be able to do better using options, which obviously are inherently leveraged in the queues. But we'll get into the pros and cons. I mean, the pros is that these things rebalance daily, so that you basically don't have to manage like that delta and gamma risk you would with options. So basically, on every down day, say one it's at 100 and the index and it goes down to 90, that means that you're selling stocks, so it's actually managing your risk exposure. So on the down days you sell, and so the reason, like say you do the TQQQ, so you have $100 of equity, um, and then you borrow $200 of from a bank somehow through a swap, to get $300 of exposure to an index. Let's just say the Nasdaq that's at 100, right? So when it goes down to 90, you lose $30 because you're 3xing the move. So basically, now your equity is only worth 70. And so you have $70 of equity and you have $200, which is much more, lent from the bank. The problem here is now you're more than 3x leverage. So now you have to unleverage yourself back to 3x, because 3x 70 obviously is 210. So instead of having $270 of exposure, you need to only have 210. So what you do is you basically sell, you would have to sell $60 of stock. So on that down day, you're selling, right? Now on the conversely, and that helps manage risks so you don't blow out. And like being in trading my whole career, I've seen a lot of people use leverage and blow out. And so we've never had a leverage an ETF blowout before. And I'm sure at some point it will happen, but we've never had investors lose 100% plus of their money. And there's a lot of investors that trade on margin that when the down days come and they're highly leveraged, what they want to do is they want to double down. So they lose a lot of money and then they want to buy even more. And so they go from 3x leverage, then the market sells off, all of a sudden there's 6x leverage, and then they want to buy even more and they become 12x leverage and they blow out. It goes down again and they lose all their money and more sometimes, and they owe the brokerage house, losses in debt. And so like that can be really dangerous. And I know somebody that committed suicide over that. So like I think that these provide a better, more like systematically risk managed portfolio, and you can't lose more than 100% in them. And we've never had one lose 100%. So yes, so I think there's a lot of safety for like people that want to trade with leverage, and that this does it in a better, safer way. Okay, so that's one of the pros. The other pro is that it compounds the upside. So you can achieve much more than 3x leverage over a long period of time. So a lot of times, like over a year or something in a sharp upward trending market, you're actually going to 4x the market. So we've seen years where the NASDAQ goes up by 400 or 40%, and these things go up by almost 200%. So they're doing more than 3x leverage as they compound. And actually, I think since inception, the TQQQ has gone up, 16 times more than the unleveraged, this like the normal NASDAQ. So you can see that compounding to the upside is driving outsized gains more than 3x. And so that's actually like a powerful mathematical feature of these. And that feature is the opposite of selling on the down days. It's buying on the up days. So you have $100, you have $200 lent from the bank. The index goes up 10%, so you make $30. Now you have $130 of equity, and you only have $200 lent from the bank, which is not enough to be 3x leverage. Now you have to go buy $60 more of stock to reach that. You basically need to reach that $390 of exposure, which is 3x 130. So that buying on the up day, if the market goes up every day and like does that for a long period of time, you're not only compounding your investment returns, but you're compounding your shares because you're buying more shares every day. And so that's a really powerful mathematical feature. It takes something like in calculus from the second power to the third power. And if you look at the chart of the NASDAQ over time, it looks like, it's like a chart that looks like calculus to the second power. And if you look at the TQQQ, it looks like calculus to the third power. And so like that's like a mathematical strength of these that I find really compelling. If you're super bullish on something and you think it can compound well over 20% for a multi-year period, that buying every update systematically in a risk managed portfolio becomes a really compelling reason to buy these if it fits your risk profile. And obviously these are leveraged, so you wouldn't do this with a lot of money or like your retirement or anything, but it is like something you could have fun with. And if you understand the risk and the downside of the daily trading, so the daily rebalancing, buying on the upsides and selling on the downside, the downside of that is volatility decay. And so this is a big misunderstanding. A lot of people think that there's always volatility decay in these, but actually in an upward trending market, because you're compounding the shares, like there's actually not volatility decay, there's that compounding to the upside. And on the downside, selling, it actually protects you because you're managing your risk. And so even if the market goes down 33% over a month, you're not going to lose 100%. You might lose 80%, which is a lot, but you don't blow out because there's diminishing returns to the downside as you continue selling on every down day. So it protects you to the downside as well. And so there's not like volatility decay when you have a sharp downward trending market. There's this protection. Where there is volatility decay is in a sideways trading market. So imagine you have an index that goes from 100 to 110, and then it goes down to 90, and then it goes back to 110, and then it goes down to 90. What you have is those days it goes up to 110, you buy $60 a stock, and then it goes down to 90, and you're selling $120 a stock, and then it goes back up to 110, and you're buying $120 a stock. And so what happens is you're selling on every down day, and you're buying on every up day, which is, that's the opposite that you should do in actively traded portfolios. You want to buy on the down days and sell on the up days, but these actually in a sideways trading market do the opposite. They sell in the up days. They buy in the up days and they sell on the down days. So this can create enormous losses over a period of time. I mean, you're definitely talking about the potential of losing 20, 30% on in a year where the NASDAQ could be flat, right? So that's a huge expense. On top of that, you have interest expenses, which are not easily discernible in these funds. Like, you don't really know whether they're borrowing money at 20% or 5%. The best way to do it is to download the underlying asset and then 2x the daily movements of that and try to figure out where the funds should be without expenses. But I think a lot of times you can see expenses of 15% plus. And so if you have a 15% expense plus and you have 25% volatility decay in a year, if you held that thing for a year in a flat trading market, you could lose 40%, right? And so that becomes a big downside. And if the market goes down, you can lose, whatever the market loses, 3x plus all those expenses. So you have while they offer some compelling upside, you also have enormous downside, which I think is much bigger than people realize. And so you really, I think, in my opinion, want to be long these things. One, when it's better for you to be long versus in a margin account, and safer. But two, also when you really think the market has the potential to go up more than 20%. Because otherwise, I'm not sure if it usually makes sense to use the leverage with the high expenses and the volatility decay.
So you could hypothetically maybe use it strategically, like of April last year, like when the market really got crushed, like buy it at that point because you feel like it's going to rebound.
Yeah. I mean, I was buying TechL at that point. So, and I'm like really bullish. I'm still really bullish on technology. So what I like to do is I like to maintain a small position in TechL and ROM and TQQQ and QLD. And so, and then when the market sells off, so even if the market's going up, I'm making some, but when the market sells off, I like to buy, sizable positions. Like when it sells off really sharply, like in, the trade wars, I was buying, TechL at like 49. And then when the market rallies very sharply, like say it's coming back to 100, that's when I sell. And the reason being is that it doesn't make sense to hold these things over a long period of time if the market's fairly valued. So if you think that, hey, the market's fairly valued, I don't think the market can go up more than 15% this next year. It doesn't make sense to use that leverage. And I could actually share my screen and we could talk about this because it's really interesting. But I think these are the things people need to think about when they use these. Like, when am I going to strategically use this? And so I'm just going to share my screen right now, and I'm pulling up a Morningstar chart. So this is the last year, and so what's really interesting here is that you see the QQQ. So this is unleveraged, went up basically 14%, which is more than the triple leveraged one. And so what that tells me is that for you to beat, so basically, I know that this doesn't, 3x something over a long period of time. It's over the daily movement, but just in your head, you can say, hey, there's 40 percentage points missing from the TQQQ if it was 3x leverage and it had gone up 3x the NASDAQ. And so really what that tells me is you've got maybe 15% interest expenses. You've got 25% volatility decay. And so when you subtract that off of, what could have been a 45 or what could have been a 45% return, you end up doing worse than the unleveraged basket. So once the market rallies back, you have to ask yourself, is it good for me to hold this for another year? Or should I go into the unleveraged basket, take 1/3 the risk? Actually, it's less than 1/3 the risk because you don't have all those interest expenses and volatility decay. It's more like 1/5 the risk, and have a higher return. And here's the other thing that's interesting. People think that the 3x1 in an upward trending market should always beat the 2x1. And you can see here the 2x leverage QLD did not or outperform the 3x1. And the reason behind that is that the 2x1 in a market that doesn't go up enough, so say a market only goes up 15% or 14% like it did, the 2x1 has lower interest expenses and lower volatility decay. So in a market that doesn't go up 30 or 40 or 50%, the 2x1 can beat the 3x1. So you can take less risk, have less expenses, and still win. And so that is really interesting to me, that like traders should be thinking about what sort of exposure they have and whether they should be doing this in their brokerage account or like is margin, or whether they should be using these ETFs as a tool. And I think it's really a case by case basis. But if we were to change the start date to say you get it on April 7th of 2025, right? So you can see the 3x1 in a really sharp word up. So now when that QQQ is going up 42%, now getting that extra 3x of the additional 25 percentage points becomes incredible. And you can actually see the TQQQ went up more than 3x the QQQ on this sharpward trending market. So you can actually, because of that compounding, do better. You can do better than 3x over even less than a 1 year period. But as soon as you get to a flat market, and I'm just going to pull, let's see where the NASDAQ's been flat from. So the NASDAQ hasn't gone up really since like October 8th. So as soon as you get to a flat market, look at that. Like, you can see that the expenses and the volatility decay really weigh on these things. So the question is, do you hold these things long term for me, or do you get out of them and move to the unleveraged basket? Because the best thing to do, I think, is that the market, if you like playing around with these and you understand the risk, you maybe unleverage yourself when the market rallies back to a fair point, get yourself into the QQQQ, and then, when the market sells off again, you have to ask yourself, is the QLD going to be better over this time period, or is the triple leveraged one? You can even see over this 5-year period I just pulled up that the QLD beat the TQQQ. So like there's really strong periods and over very long periods of time that the 2x leverage basket can beat the 3x leverage basket. And then you could even ask yourself, like, is it really worth all this extra risk for when the QQQQ has a potential, like, is unleveraged and is way less risk and has the returns that are almost the same? Or they're less, but like you're going to sleep a lot better knowing you're not losing 60% in a sell-off. So, I think these are all things for people to understand, but the biggest thing is being honest about the expenses associated with these. And a lot of people would say, hey, if I think there's 35% annualized expenses between volatility decay and interest and all that, like what should I actually be buying and holding this versus just being unleveraged? Or should I be taking 3x leverage or 2x leverage? Here you can see, like, this is the XL versus ROM versus XLK, and these all use the same index. They all use like the S&P 500 Information Technology Index. And you can see here, once again, the XLK beats the 3x one, even though it went up 18%, and the 2x one beats the 3x one as well. Over a 5-year period of time, that's what it looks like. So I think like the 3x one wins on this chart over 5 years, over the 2x and the 1x. And then if you were to look at like year to date, like you can see that that in this market, because of the expenses, even though it's only been a month and a half, that you are more than 3xing the downside and more than 2xing the downside in ROM and TechL over this time period because of the expenses associated. So these expenses are much higher than people think, really is my biggest thing. And so people should be really tactical and understand that and understand how to use it to their benefit and when to avoid it.
Yeah. Like I've been trading a lot of options on the triple leverage, like this, say the TQQQ. Say like if it's trading at
Michael,
$55.
did I stop sharing my screen?
Yes, you did.
Okay.
Yeah. But yeah, say like if it's trading at 55 and it pulls down to like 50 in a few days, I might sell like a $45 strike
Yeah.
and try to get a rebound. Like, let me share. I'll share my
But Michael, why would you not just do that on the QQQQ? Like, why are you choosing the TQQQ?
for premium for the
Yeah, but
options premium.
you could just sell more options, and
Yeah.
you'd be taking the same amount of risk, maybe less, if you sold more options, because you wouldn't be exposing yourself to the downside of the volatility decay and the interest expenses.
Yeah. Well, like I'm gonna pull this chart up for 1 second. Let me share this because um, if you trade in my, let's see.
It's just like when you have puts, like you're going to be eating that those expenses of those other things versus you wouldn't be eating them if you did the TQQQ. So you might actually have higher returns doing the same strategy with less risk, with less risk.
So like if
In the QQQQ. I'm not. I mean, I know that I don't know how it works exactly with margin on the differences between those two things, but
yeah.
it would be interesting for you to track the difference, like over the next year, every time you want to do this, say which one would have made more money, and I'm going to write down what the price of the Q's put was, and I'm going to write down what the TQQQ put was, and I'm going to see, or I can do both trades and see which one made more money. Um,
Yeah. I
yeah.
definitely I don't use margin, but for example, like it's
So
this
are you selling when you're selling the puts though? Are you selling like if you had to take delivery, you have the cash in your account to take delivery of all
yeah,
the
yes.
okay. Okay, well
So
then yeah, so I understand that. Got it. Because most
so like
people trading options I think don't. Like they're not selling puts like Warren Buffett is, and they wouldn't be able to take delivery with cash of the puts they sold.
with this the QQQ, it's it trades different as far as the price. Like it's over 600 the QQQ it's $600 dollars, plus a share. So if you were to do one contract, that'd be like $60,000, and you would have to have $60,000 worth of collateral, and then the TQQQ,
So you're just selling like one contract on so you're not selling
yeah,
like
or
enough
maybe five or
contracts
six,
that
but not meant,
but then you could sell just one on
right?
the Nasdaq. I mean, or you could sell three on the Nasdaq because I mean you're basically saying you're not doing this leverage, but if you were to take delivery of the TQQQ, you would be leveraged. So I'm not sure if that's the right way to look at it, but like I think that you could sell it on the QQQQ, like sell if you're doing say you're doing six of them on whatever, you could do two of them on the QQQQ and be taking the same amount of delta risk on the Nasdaq 100 index. So you'd be exposed to the same swings either way, but you wouldn't be exposed to all the expenses associated with the with having a 3x one because you're trying to leave as much upside on the table. You want the stock to be as high as you wanted. If you were selling calls, maybe I would tell you, hey, sell the calls on the triple one. You know what I mean? Because then you have those expenses So if you were taking a negative delta position, I think maybe it would be better in the triple leverage fund. But if you're taking a positive delta position in your options, you just have to think about how the expenses play into the strategy. And it's not saying you're not making money in this. The question is, could you be making more? I don't know the answer, but I think if you compare it over the next year, it'd be interesting, and we could do this again and like say, should
Yeah.
you be doing this? It would be an interesting call.
Yeah. Like as far as option selling, like in my opinion, like if you sell too many, like especially with calls, you can cap your upside in the market, is going upward. And
Oh, I totally agree. I don't think you can be selling calls on something you're bullish on. But like you do have to pick which vehicle you're taking positive delta on because you want to leave the most upside. And so that's my only point. And for Michael's audience, I was a professional options market maker in Chicago. So I have a lot of options trading experience.
How do you do your option strategies when you do them or have done them?
So I don't do them anymore. And the interesting thing was, I mean, I was doing them leveraged. I think you are doing them leveraged as well if you're doing them on triple leverage things. But like, I was trading at leverage, but my results were not equal to the leveraged returns of the S&P 500. Okay, so I was taking this 3x risk, and I wasn't getting 3x the return. I was getting maybe slightly better than the S&P 500 was doing. And so I was like, at the end of the day, I thought, I have a lot of like stress when this stuff sells off because you're losing a lot more than the S&P 500. And when it does well, you're making more, but you're not making that much more. And so I eventually just said, I think I'm just going to focus on buy and hold long only trading or like investments. And so obviously I started AOTP and then later AOTS, and I focus on buying and holding long only, equities, large cap, profitable, low marginal cost, tech and growth oriented companies. And so that's the strategy I think provides the most upside in my opinion with the lowest amount of risk. And that's why I do it with all my money now. But when I was trading these, I was trading at leverage. I coming from the market making world, realized that like you lose a lot of money when you cross the bid ask spread a lot. Like you might be losing 1-2% on every single trade. And so my idea when I was still employing options trading strategies in my personal like investment accounts was to trade as little as possible, maybe trade farther out puts and calls, and to do it from I would always do it from a long delta side. So I'd always want to be long the market. I would never be short. Um, so that generally involves, selling puts more versus selling calls. But sometimes I would have short options on both sides. So like I'm more of like a straddle exposure. And when I thought volatility was really high. And then there'd be times when you buy back when the volatility comes down. But I also would watch the options chains and the options skew. So if you chart, I don't know if you do this, Michael, but if you chart the bid-ask spreads on every single strike, it makes like a skew. And so you can look at where you look like, hey, I think this part of the skew looks a little too expensive. This part looks too steep. And so a lot of my trading was really based around what the market opportunities were at the time, not exactly like the best strikes or the best things in my opinion. And so like I tried to take like a little bit more of like look for the market opportunities in a specific security. But like I said, I think that when you trade options, like the institutional trading market makers have the most advantage, and you as a retail trader have the least. And so the way you minimize their advantage is you gear towards more buy and hold and less frequently traded. Otherwise, you're playing at their casino and they're winning 52% of the time or whatever, but they're taking that 1 or 2% win every time you just make a trade. And so focusing on long-term buying and holding, a lot of times I would do options that were based 6 months, a year out. But like even when I trade now is like an investment portfolio for ETFs, I really focus on long-term buying and holding, not actively trading and high turnover. So I really think that's important when you're a retail trader, because I just don't think the more you trade, the more advantage you hand over to the market makers, and the more disadvantage you give yourself, in my opinion. So that's just like my personal opinion. I know there's going to be people that are like, no, I trade every day and I'm really good at it. And that's true, but as a whole, it's not going to be true for most people, I think. And it wasn't
Yeah.
true for me, I don't think.
Well, I did pretty good in the month of January, but then I was using some of these Mag 7 stocks, and I was doing like a wheel strategy on MSFU. It's a double
Yeah.
leverage on the Microsoft. And when it rolled against me, it showed me the reality of what could really happen. And I'm going to share my screen because I want to show you how bad it just went. Like, it was actually pretty shocking to me how it went. So I was in this about in the high 30s and per share, almost close to $40. And basically, it just went off the cliff one day, on the right around here. And I was Microsoft did, and right here, since Microsoft went down, I believe it went down 20%, but I went down like 40% just
Yeah.
because of that.
Yeah.
So
I mean,
it's
it's leverage. You know what I mean? So you think, I don't know, you're taking leverage when you're doing this on those things. It doesn't look like leverage because you're like, oh, I can, I have the cash in my account and I do this, but you're really doing 2x whatever the cash you think you're doing. So I mean, yeah, I mean, I think
it
the
was an
thing about
expensive
selling
lesson.
options, I think the thing about selling options, and I've always been short options in my trading book. So when I was a professional doing this in Chicago, when I was doing it myself, always traded from the short side. Is you make a lot of you make good steady money for a long period of time on the short side, and then when the pain hits, it's horrible. You know what I mean? And you can
Yeah.
hand back all of your gains. So you could be making money for 11 months of the year, and you're like, I'm super smart, I'm really good at this, and I'm way outperforming the S&P 500. And then you have your one bad month where where the market's hit and you have all this downside, and the volatility goes way up, and you're losing money on your options, and it wipes out all the gains for the year. And then you're like, not only did I like not outperform the S&P 500 anymore, like I way underperformed it, and I took way more risk. And I did like it was like I was doing this actively, so it's like a job practically, and like I still like didn't have any return. And so it's just an enormous waste of my time. And why didn't I just take my money and put it in the Nasdaq or something? And that's like the question I had myself. And so that's why I moved away and from doing options. And I just didn't think it was worth the time or the mental effort. Um, Not like if I'm not like a market maker doing it with high speed and stuff, right? So like I think
Right.
it makes sense for some people doing it professionally, but like for me, I don't think it made sense as a retail trader. Um, and Yeah, I mean, Michael, I would just say that like I'm not sure how much sense it makes to take long positions in these leveraged ones when you could just do it in your options or in the single name accounts and have the same downside without the volatility and that expenses.
So I pulled up a
Yeah,
stock soul on
yeah,
stock analysis, and right here, like during the when the market rolled over, when I guess you call it the trade wars, um, Soxo got down to looks like around $8 or $9 a share right
wow,
there,
yeah,
and I guess like that could be a strategic way. Like say if you just bought the shares and then about a year later it's 6 or 7 times the amount. Um, I don't know. But if you sold an option on it, I guess you would just get that little bit of premium, and then you wouldn't get the big gains out of it.
yeah. I mean, um, like you could do it on the unleveraged basket is only my thing. So like you could just sell more delta exposure on the to the index on the unleveraged basket, and you could have the same exact returns, but without paying that volatility decay and the expenses. So my thing is like, look, you could make money doing this, but could you make more not doing it on the leveraged ones and options? Now it's different when you want to buy and hold these things because now you want to buy and hold, and you're bullish on semiconductors because it's sell off. let's just say you don't even have a margin account, right? And you could go buy SOXL and you could ride it up, and get 3x exposure to semiconductors doing well. Like now it becomes the best option for this person to express their extremely bullish view on semiconductors. So like I think that makes some sense for them, and that's the way I basically kind of use it, which is like this makes more sense and it manages the risk better, and I don't have to trade daily to maintain my exposure, which is like super time consuming. So like for me, like buying SOXL, if I was really bullish on semiconductors, say at the end of 2022, so like end of 2022, semiconductors got murdered. Like everybody was like, there's a semiconductor glut, and like I was long these things, by the way, that whole time. I never believed it. But like Nvidia was down 75%. Like SOXL went from like I think it was like went from like 75 down to 8, right? So this is a fund that lost almost 90%. And like if you were really bullish on semiconductors like I was, now I bought all these semiconductors and I held them, and I didn't take a leverage stance on them at that point. But like if you were really bullish on them, you could have bought it at 8 and you could have ridden it, back up to 65 today, right? So like that's better than like that's 1,000% return, and that's better than doing it on or not 1,000, but it's a high percent return, and that's better than doing it in the unleveraged basket. And so I think they provide some good opportunities for you, regardless of the high expenses and the high fees, because they manage the risk better. But I think like that's from like you don't have other options. Now, if you wanted to take a call and you wanted to buy, 1-year leap calls on a semiconductor index, would that have done better than the 2x, 3x one? I mean, I guess it depends how far out you bought the call. If you bought it 100% above and then you ended up going up 300%, right? Like you probably would have done a lot better because you could have more than 3x it and you could have put maybe less risk. I don't know. But you could definitely do better in options on the long side and on the short side, I think. But it requires like, it gets a lot more complicated to manage the options book, and it takes a lot more skill than just buying SOXL or something. So to me, like I think I would rather just buy one of these in the sell off than try to pick the right strikes and try to make sure I'm getting it at the right volatility levels and things like that. But I don't know, these are all complicated things, and I think that's the biggest thing for traders to keep in mind, like how complicated this is, how opaque the information is. They don't know what the volatility decay is. They don't know the interest rates the funds are being charged. You read the prospectus and they say, there's an expense ratio, plus we pay commission, plus we pay interest rates. And it never says what they are. You're like, what are they? And I've seen them be as high, really high in these things, like higher than you would pay in your brokerage account. Like, so then it's like, if I can borrow money at 5% in my brokerage account, and these funds are paying 10%, 20% to leverage, like that doesn't make any sense. So ETFs aren't allowed to borrow like a broker, like you would in your trading account. Basically, it's against the law for like a ETF to borrow money. So what they do is they buy a structured note from an investment bank instead. So they go and buy this structured note. It says it's going to provide 3x or the upside or downside from an investment bank. And so the investment bank's structured note fees can be very high, and you don't even know what they are when you're doing this. And the ETF has to do it because it's what the regulations are. So it's a good story of regulations making things much more expensive and worse for investors. But then basically the investment banks say, hey, like you want to be 2x leverage? Well, here's this note, but this note says you have to keep all this cash collateral. So now to actually reach your 2x leverage, 3x leverage, you have to overborrow because you can't even, like usually in your brokerage account, you buy $100 of stock and you borrow another $100 to buy another $100 of stock. In these swaps, you have to leave the $100 in cash and borrow $200 to get the exposure. So you're actually borrowing twice the amount you would normally in a brokerage account. You incur much higher interest rates than you would normally in a brokerage account if you're borrowing near the federal funds rate. Now, here's the thing: Robinhood charges a really low borrowing rate, but Charles Schwab charges like 12%. So it's like, are you paying 4%? You paying 12% in your margin account? Are you willing to trade it daily? All these things, are you willing to sell on the down days and not double down and blow out? So like there's all these considerations to take into account with these, and it's really complicated. And I think most people I've talked to that use them don't understand the volatility decay. They don't understand the high interest rates. They don't understand how borrowing works in ETFs, and they don't understand how it manages the risk differently than a margin account. So I think like just some people are very skilled when they do this. Some people are just kind of like they look at the chart and they're like, look at how much money this thing's made. Like I should buy that. And they don't think about like the 2x one could make more than the 3x one if the return's only 15% in the index, or if the market stays flat, they could lose 30-40%. And so in a year and a half. And so I think those are just all things that then also kind of bleed into the options trading of, well, if I'm trading options on these things, how do I do it? Do I do the underlying? Do I do the 3x one? Do I want the volatility decay? Am I trading it for a short enough time period that maybe it doesn't matter? Things like that. So I don't know. What are your thoughts, Michael?
Well, I'm going to share my screen on my option spreadsheet because,
yeah, let's see it. And like, how much have you made trading your options, and what principle were you using?
I've normally been selling cash secure puts on red days, like on TQQQ. Like, for example, this one right here, I opened a trade on February 5th, and I sold a $43 strike, and I received $224 for it with one contract. So actually, my risk would have been the 43 minus the 224. But then the very next day, when the market jumped up, I bailed on it and made $91. So maybe about a third of it. And that's the kind of way I've been doing it.
But my curiosity that I'm wondering is, so how long have you been doing this for?
I've been trading options for years, but I've not been messing with the triple leverage ones until this year.
Okay, so you mean like in the last year or like this calendar year?
Calendar year.
Okay, all right. So what's been the total premium you've made or lost in the last calendar year, or in this calendar year?
Well, I had made say $4,700, but that Microsoft trade, the one I told you about, and I had a couple different ones that actually turned against me. I'm actually blowing all my gains back because I lost $4,000 on. Yeah, I'm negative. If you count the, yeah, I would say I'm negative because I messed with the single stock, which I shouldn't have done that because that goes against my principles. But
I mean,
I like a basket.
Look, like that. There's nothing like I actually like really appreciate the honesty there, and like I think it's good for people to learn from like things that we've learned, right? And I basically, and like, would you have been better off just putting your money in the QQQ this year, and like, would you have like for the principal you were exposing, would you have done better in the QQQ? And I think that there's a good chance the answer is yes. And that's what I saw myself in my options trading, right? So it's like I'm not like like that was my personal experience. So if you're a better options trader than me, I'm really happy for you. And if you're not, that's okay too. Like by the way, like that's just the thing about these things. You can look like you're making money for 30 days in a row, and you can have one or two bad days in options. When you're short puts, it can be really bad. And especially when you're short puts on a leveraged vehicle. And so, I mean, if this is my personal experience with options too, and then the question is, if I do this for a year or 2 years, and I don't make more than if I just put my money in the S&P 500, like in the future, should I keep trading options, or should I just put it in the S&P 500 or the NASDAQ or whatever? I mean, maybe you buy whatever fund out there is, whether it's like AOTG or Tech or the XLK or whatever. It just depends on what you want exposure to, whether it's tech or the S&P 500 or what. But it's like you just have to be honest. And I think the interesting thing I see, like in professionals doing this, is you have these private equity funds, and they're leveraging themselves 3 times. Okay, so there's 3x leverage, and then they go and compare themselves to the S&P 500. And you're like, that's insane. Like you're 3x leverage. Your fund would have blown out. So you don't allow anybody to take any money out in a downturn, right? Like they're like locked up. You can't take money out for 5 years because they've lost so much money if there's a downturn in the market. And they only allow you to take your money out when the funds recover and stuff like that. And so it's like, I see these investment professionals taking 3x leverage and they compare themselves to S&P 500. And I just don't think it's like a good comparison either. Because it's like they are making these private equity fund companies usually aren't even making the returns at S&P 500. But then they're like, look at what a good investment we are. We return 2% more than S&P 500 the rare times they use them. And then they are like, I don't know, there's 3x leverage, then like it's not a good comparison. And these people that bought them were taking way more risk. They were not allowed to withdraw their money. They have really high taxes, and you don't have that in the S&P 500. So the after-tax return, the risk-adjusted return, it's always like fractions of S&P 500. And I think that's similar to how it is with options. You have to pay taxes, right? You have to pay taxes when you have gains, and they're taxed at short-term, long-term split, but it's tax inefficient. So that's not good. It's quite often leveraged, and your returns might not even be as good as the unleveraged basket. And so that was my personal experience. But I'm sure there's much better options traders out there that can do it better. But I am like a good investor from that. Like my funds have, in the last since inception, or AOTG has done much better than the S&P 500 since inception by a wide period. So by a wide margin. So it's like I'm not like a complete, like I do know what I'm doing with investing. The math just didn't make sense for me in options.
Yeah. Like I said, one thing, even with any kind of investing, as far as my luck, it's always been better with indexes, or at least a basket. Even like with the AOTG, it's a huge basket of companies versus just like trying to pick the one. And if the one goes against you, then you're going to feel it, And I guess with this triple leverage, tell me if I'm wrong, but I feel like that me personally, I might be better off if this like using them for like severe market downturns, like the April of last year, and just not really mess with them, but then take the opportunity if it presents itself and just buy and hold and maybe 4 or 5 times your money, hopefully, on the upswing.
I mean, I think the thing about tech is it can be very volatile. So there's sometimes when technology is really hot and it gets overvalued, and there's sometimes when it's really cheap. And so we saw it got really cheap in 2022. Nobody wanted to hold it. I feel like we're kind of getting there in 2026, right? Where we're seeing a lot of sell-off. Here's the thing, semiconductors have done well, so it's kind of masking it. But tech minus semiconductors has done really badly. Like the software index is down like 20% year to date. And so there's pockets of like software where the PE ratios are in the teens, the forward PE ratios, and they have 100% earnings growth. And you think like this is the potential, in my opinion, a lot of these stocks to make 100% in the next year. And so that's a good year to say, hey, like I'm going to go use a leverage vehicle to get leverage exposure to this. Now, I don't think there's any leverage software ETFs actually out there. There are some like AIBU is a directed one that's like 2x AI stocks and stuff. So it's pretty close. But I mean, the interesting thing is like you really want to use it strategically. And a lot of times you have to be honest, even if the market goes up by 20%, you could underperform the index. So you need the market to go up by over 20% to be sure that you have a chance of outperforming the index. And what are the odds of the market going up by more than 20%, right? That's like a really high rate of return. So you know that the odds are kind of stacked against you to do better in these things. So you want to wait until the market's really cheap to use these things. And the funniest thing is whenever tech L goes down and I'm buying it or whatever, like I always put in a fraction of what I want to put in, because whenever I buy this thing, it's like a falling knife and it just keeps dropping. So I need to be willing to defend the position a little bit. So if I buy at 70, well, I better buy at 49 again. And if it keeps going, I better buy at 39. And that's what it did in the trade war, right? It goes from 120 to like 30. And so I always put in much less than I want to put in. I always am putting in only when I'm 100% willing to return, like lose, and know that it's a short-term fund trading vehicle. And I do have that intention of technology becomes more fairly valued, because I'm most bullish tech, and you wanna be long these leverage vehicles, what you're willing to, like what you're most bullish on, of course, and then be willing to convert back to the unleveraged basket, um, basically when the market gets fairly valued, because you'll underperform. You'll underperform if the returns are maybe under 20%. So these are all things that you need to understand about these vehicles and the way to use them probably. But everybody uses them differently, and a lot of people like to be short them, I think, because they don't like the volatility decay. They don't like the interest expenses.
Yeah, I mean, they're definitely interesting, and uh, like when I said I hit that MSFU, the Microsoft one, it showed me the reality of that these things can be dangerous
Yeah,
quick. You know.
and that applies to all ETFs that are using leverage. There's a lot of different ETFs using leverage, but sometimes they're not these like 2x ones. Sometimes they're like covered call ones that are using swaps. You get 1.5x leverage. Sometimes they're like, um, they could be private equity funds, right? And so there's a lot of different types of leveraged investment vehicles, but in general, they all provide some form of bad downside, which is like higher expenses, potentially volatility decay, and interest expenses that you might not understand.
Yeah, I remember I've had you on the channel a few times, and I remember I've heard you talk about the swaps before, and that they can cost more than what you realize. You know. Um,
Yeah, and anytime investors see that like a fund is using derivatives like swaps to get exposure to a basket, that should that should be a big like people should stop and hesitate and try to understand what the risk is of that. And so like even say you're like using swaps like or derivatives like futures, to get exposure to like I don't know, like gold or Bitcoin or silver or whatever commodity, oil. Um, Basically, the futures market can become dislocated, right, from reality. And so you've seen oil go to -20 in the futures market. You've seen in natural gas, the cost to roll a thing might be $2, but to roll it from the next month is $14 to $2. And you've seen that in oil too. There was one time oil, the cost to roll the contract, it was -20 to sell it, and to go back long again, it was $20. So you would lose 200% rolling your contract. And so when you buy these vehicles, as an investor, there's really confusing things that can happen that can cause the fund to lose all its money. And and it's not like buying and holding stocks, which is the best way an investor can do well in the long run, I think, in my opinion. Because when you buy and hold a stock like Nvidia or AMD or Google long term, nobody can ever force you out of it. You can't be forced to sell it. You can't be forced to buy it. You can't be forced to lose all your like money or lose more than you invested in it. When you buy these other funds, like and you're leveraged, or you're doing futures, one, you have to roll it, right? Including like covered call ETF, you have to constantly be selling more. You have to be rolling the options contracts or selling more. So you get forced out and you get forced to roll your position, just based on expirations. It's the same thing in futures where, oh, this contract's expiring at $20. Well, if you want to stay long, you have to buy the next contract, and guess what? That's at $30, right? So like you get forced to roll, and the rolls can be very expensive in times of panic. And then you also get exposed to like this derivatives market, which can embed interest rates. It can do things like that. There can be contango. There can be backwardation, and so you have all these other costs that come into play. And I was like a commodities market maker, so like I learned them really well and what to be cautious for. But I think like if most people getting exposure to like a managed like leveraged like commodities fund, things like that, have no idea. And a lot of these funds you see like over time, like if you were to look up USO, Like I'll just show you this one. I'll share my screen. Let's see. So USO is basically a stock that invests in oil futures. All right. So it's not buying oil itself. It's doing it through futures. And that's a big thing because that's a derivative, right? And so there's a cost to roll these contracts. And you see this quite frequently in derivative-based funds. They trend to go to zero because it's so expensive. And the derivative risk in times of panic becomes enormous. And so it's dislocated. It's like the price of oil, we all know over the past like couple of decades, maybe it's gone up a little bit. Maybe it's gone from 40 to 80, so it's gone up 100%. But like when you look at like USO, which is basically an oil, it's an oil fund that that buys futures, and so you can see it's lost 86%. You know what I mean? And so this is an unleveraged fund. This is by futures unleveraged. So if it had been leveraged, it would be so much worse. But this is the cost to roll oil futures. It's not that oil has gone down. It's that you have to constantly be expiring your position, selling it, and buying at a higher price over a long period of time. And in times of panic, you get destroyed. I remember, like this is when oil went negative, right here, and you can see that it lost 77%. In this little time period when oil went negative because the cost to roll the contract was so high. And so I think that's just what people need to remember about like derivative-based funds, whether it's in options or whether it's in futures, is you lose your biggest advantage as a retail investor to buy and hold and to never be forced out of position and not have to actively trade and get pushed into things. And I would say like if you want to be long oil, you better own oil storage. You know what I mean? Like you better. And it's the same thing if you want to buy like a gold ETF. You better be buying a gold ETF that takes delivery of the gold and holds it in a vault. Because if you're doing it in futures, not a good idea in the long run. Because the futures market, the cost to roll can come so high that the trend, like you're paying somebody else to store the gold for you. They end up making all the money at the end of the day. Just like the people that were storing the oil for these oil futures funds. And by the way, it's a lot easier to just buy futures than like operate oil storage in like Louisiana or something. So like I understand why, but like it's just really expensive and it's not a good long-term investment. These I think derivative-based vehicles in the long run, just because of the expensive cost of derivatives.
So I guess let's sum this up. And what's, in your opinion, what is the best opportunity to use leveraged vehicles?
I think it's in a really steep sell-off where you remain extremely bullish. So like if there was Trump trade war and you weren't the person saying the economy was going into a recession, you were saying you were like, hey, this is ridiculous. The economy's super strong, and I actually think this will be good for our economy. That's like a good time to express a very bullish view. Maybe you don't have a margin account. Maybe you don't want to manage it daily and manage the risk. And this outsources that risk management. It outsources the daily trading, and you don't have a margin account, so it gives you the best way to achieve leverage without having to like go through all the extra steps. And that's a really good time to use it. And it can be a great tool for investors in those areas to express a very bullish sentiment that you think the market's going to rise over 20 percentage points in a short period of time, like a year or less, and you understand the risk, the volatility decay, if it continues to go down, that you could lose everything, right? And you're not doing this with your retirement or the funds you're saving up for your car or something, but you're doing this with like fund money, which you're 100% willing to lose. I would say that's like the best way to use it.
Yeah, I kind of agree with you after my experience with it so far, or definitely on, very red days. But anyway, uh, they're very interesting to say the least.
Yeah. Well, if you like volatility and you like watching your portfolio go up by 1 or 2% today isn't enough. Like you want to see it going up down or up 6%. They certainly add a little bit more thrill. But at the end of the day, I don't think they're good long-term investment vehicles unless you're extraordinarily bullish over the next couple of periods and you believe that you're going to have annualized returns over 20%. So, like it needs to fit your future beliefs and it needs to fit your risk profile in it, and you need to understand realistically the expenses involved in doing this, which are very high. So, I mean, that's like my thought. And it's not like you couldn't buy and hold it for the long term. You just have to continuously believe that, like, maybe you reevaluate it and every month, and you continuously believe that your bullish stance remains, and so you're going to hold it for another month and reevaluate in another month. And yeah, that's what I would say.
Yeah, sounds like you make a lot of good sense with it. Can you tell everybody your website so they can look up your funds if they're interested in them?
Yeah, so AOTG is the AOT Growth and Innovation ETF. AOTS is the AOT Software Platform ETF. My website is aotetf.com. You can view both of those. But I think what's really compelling right now is that software has gotten really hit year to date. And it's been hit kind of in 2025 as well. And so I think it creates a really good investment opportunity, in a long buy and hold, long-term capital appreciation goal within these funds that have a lot of software exposure to ride that rally back and to do really well. And AOTG focuses on really high earnings growth companies. And so I think that, to me, like, I hold these things with all my own money, or almost all my own money. And so, like, I believe in that, like, long-term power of growing their earnings at very high rates and to continue to have great, you're investing in companies now that have low valuation metrics that should raise future returns, should their earnings growth continue. So I think it has the potential to do really well, and I'm excited for what the rest of 2026 will hold for these funds.
Well, John, I'd like to thank you for coming on the channel. I mean, it's a blast as always, and I appreciate your knowledge. I'm sharing it with the audience and everything. And with that being said, until next time, I will catch you all later.